Hey everybody, Marty Mazur. Good afternoon, 18th of April 2016. I think I can keep this one very quick. The meeting in Doha over the weekend was a dud. They did not agree to a freeze, despite what we heard earlier last week from a Russian news agency that a freeze deal was met, which pushed oil up a bunch and the market up a bunch that day. Didn't happen. Iran backed out at the last minute. Saudis said, essentially we're not going to agree to any freeze unless we get other major players to do it as well. And again, as I've suggested now for a long time, not just me, by the way, of course, Saudis seem to be making great headway in their quest to hit production, particularly in North America, hit the competition. The U.S. is now below 9 million barrels a day. We were at once 9.6 million in terms of production. So they're stealing back market share, and I think they're going to continue to try to do that for a while longer. I'll no doubt get more into some of the supply numbers and so on. We definitely are seeing equilibrium at some point in the not too distant future. So it would make sense that oil didn't have to fall apart as so many people anticipated on today's meeting, although I actually expected it to, and it did. It was down 6% at one point, but it didn't close nearly at those lows. And overnight, when the market realized that the deal wasn't going to happen, Dow futures were down 100 points. But it didn't play out that way. I think a lot of people got hit pretty hard who were short this market based on their thoughts that the Doha deal wouldn't happen. What didn't happen, and the Dow rallied over 100 points today. I think you can thank, among probably a lot of things, William Dudley, the New York Fed president, in a speech this morning, was just essentially very dovish. He basically made the market very comfortable with the notion that the Fed is nowhere near ready to get aggressive with interest rates anytime soon. So I think the market took that to heart and rallied on that as much as anything else. The Fed, I think, is ultimately concerned with the dollar, as I've explained already. As long as they can keep the dollar kind of at bay, I think they think that's better for the U.S. economy. It's certainly better for exporters like companies like IBM, multinational companies. They announced after the close today, and they beat earnings and revenue estimates and actually rallied a couple of percent initially, and mentioned that the FX or currency headwinds weren't there nearly to the extent they were last year in the first quarter, which is kind of what I've been talking about, and that I expect forward outlooks to improve based on a weaker dollar. However, their outlook did not improve. So that rally that traders basically orchestrated right after the announcement in the after hours went away, and some, when IBM did not increase or raise their guidance going forward. Netflix was also just getting pummeled after hours. So it'll be interesting to see how the market wakes up tomorrow morning with a couple of kind of bellwether stocks in their earnings. Disappointing, or at least their outlook's disappointing. Okay, so here's the chart in front of you. I've cleaned it up quite a bit, and left, I think, just what I think are some key levels to pay attention to. The market really struggled with this trend line connecting this top and this lower high for a while, until it broke through, and then it broke through and basically didn't even come back and test it as support, and it shot up to the next level of what you would expect resistance to be, and that's the connection of this summer high with this lower right here, high right here in the fall. So notice how the market just came right up against that, and that's where the day ended. The next level would be connecting the May all-time high to that July high, and seeing if we can penetrate that there. And then your next defense or resistance would be right here, which would simply be the all-time high of about 2135 on the S&P. So it's my view that we could very well see the market penetrate that in the course of 2016, maybe sooner than later. I am surprised, though, that we're getting very, very close, within a couple of percent right now. I really thought there was enough resistance in here to set the market back a bit to consolidate before it shot up to those new highs. In fact, that's what I've been seeing in some key technical indicators. One of my favorite is this MACD line. I've explained what it is a couple of times. I'll just in the interest of time, I'll skip the definition today. But this one tends to be a pretty good signal for the market. You notice I drew some trend lines here. Take a look here back when we had that correction. Oops, wrong one. when we had that correction in, let me get that one. There we go. Correction in August, and we came back down and just about tested those lows. So we draw a trend line here. Look at the MACD though, was actually showing us something different in terms of momentum under the surface with the moving averages. Notice here, if I were to take this and draw a trend line, oh boy, I keep grabbing the wrong one. Here we go. Connecting what basically happened here on a closing basis, right? You can see, yeah, you can see. There we go. Yeah, that's the trend line, and I'm doing it on a closing basis there. You can see what the trend line looked like when you connect the bottoms there, but look at the MACD. The MACD was telling us something else, something worse, that the momentum was really fading and that this market was probably poised to sell off in May. It sure did here, and then we tested some levels. Let me reset this here. There we go. And then we tested this, and then we tested again a little lower. So we have this trend line, but all the while the MACD was showing strength, and then we got this very nice rally that we're still in. And I began warning you right about here that maybe this is something that we shouldn't be believing in much further than this level here. As the MACD was rolling over, as it did here, notice how similar this looks. Those two are virtually identical. This looks very much the same. Started to roll over, and then the market, you know, see how it fought it, and then finally gave way. Here it is kind of doing that again. But one key difference that has nothing to do with these technical charts, or at least ultimately it will influence them in terms of the signal, is over here we had a Fed who was really basically setting us up for a rate increase in December, and then look what happened afterwards. Here we have a Fed who's trying to set us up for no more rate increases anytime soon, and I will be shocked if they move even in the June meeting with what they have up against them. And I keep talking about that referendum in Great Britain. I think that's a potentially a pretty big deal for the market and for monetary policy. So I think the Fed, they're going to talk about the signals, they're going to talk about inflation, and they're going to justify why they're not going to be raising interest rates. And probably we're talking, you know, September. I will still be surprised if we don't see at least another hike or two this year. But as the year gets older and we don't have it, then maybe not. And that not raising interest rates clearly has been something that the market likes. So in here, while we have this, I think, signal that this rally is maybe reaching its peak at some point, at least on a short-term basis, it hasn't been. And maybe this turns back up. These things, history does not always repeat itself. These are just signposts along the way. Could they be wrong? Absolutely, unequivocally, yes, they could absolutely be wrong. So this is the stuff of short-term trading. This is the stuff of technicians. And this stuff can really influence markets. So if tomorrow this turns out to be resistance, we're going to be building into an upward sloping wedge pattern before too long, and those are things that tend to break out to the downside. So these are the things that technicians are looking at, as well as volume and other things that I've been showing you. And I would say the technicals have actually been improving notably from when I first started talking about a potential topping right back in here. So while I still have that signal, if you look at the MACD line, you compare that trend to what's been happening with the price, typically you would expect the price to catch down to what's going on in the MACD line. We'll see if the price doesn't win out and we continue to see this market rally further. But right there, what do we have? We have that upward sloping wedge pattern. So that actually could mean that there could help technicians give up the ghost sometime in here. IBM's earnings this afternoon didn't help. Netflix's didn't help either. So it'll be interesting to see how we trend tomorrow. Folks, again, this is not something that's actionable for you. This is not advice, trading advice, or anything else. This is just giving you a heads up as to what some of the short-term indicators are maybe signaling, so that when we do get that volatility that I think is inevitable, you at some level you say, hey, it makes some sense, and I'm going to keep my long-term perspective and continue to hold my good stocks in a well-balanced, diversified fashion for the long term. But it doesn't hurt to understand some of the forces that make me wonder what's going on a day-to-day basis. Thank you, as always, for watching and listening, and I'll talk to you soon. Bye-bye.